fixed rate versus
Hello
adjustable rate on
guys.
loans.
Do you people remember that during the time that inflation soared high and cost of borrowing became higher or increased, some of you received email and messages from your banks that the amount you are supposed to pay to service your loan has been reviewed higher or has been increased because of what? Because cost of borrowing has been increased. Well, there is a follower in my DM that is asking whether since the Ghana reference rate has been reduced and cost of borrowing has been reduced, the loan that he's servicing now, the amount he's paying, is it going to be reduced, or the interest on his loan, is it going to be reduced? I think it's a very logic question to ask. My name is Dr. Victor Brentasi, and my purpose is to bring you information that's going to enhance your financial well-being. So now that interest on loans has been reduced due to reduction in the Ghana reference rate, if you want to know Ghana reference rates and how it affects loan, you can watch my previous video on cost of borrowing has been reduced or interest on loans has been reduced. You search for it. So the question now is, now that cost of borrowing or interest on loan has been reduced, should the loan you are servicing now, the amount you are paying, should it be reduced? Or should the interest on the loan you are servicing now be reduced? It depends. We have two types of loans, interest on loans. We have fixed rate and we have fluctuating rates. Fixed rate is when it's locked in. The amount you are paying is fixed. It doesn't change. The amount they tell you are going to pay throughout the loan period, whether interest on loan is increased or interest on loan is reduced, you are going to pay the same amount. Now, with this type of loan, it's very risky. And a risk-averse person like me will always go for this type of loan so that I will be certain that this is the amount that will be deducted from my salary every month. Now, let's go to fluctuating rate or adjustable rate. Adjustable rate is influenced by market condition, meaning that the amount that you're going to pay every month will differ based on the market condition or based on cost of borrowing or interest on loan. Meaning that if interest on loan increase, the amount you're going to pay on your loan will increase. And if interest on loan reduce, the amount you're going to pay for that period, for the period that has reduced, will what would come down. So you remember that during the time that inflation soared very high, most of you, some of you, let me use some of you received the message from your bank that the amount you are paying for your loan has been reviewed higher or it has been increased because cost on loan or interest on loan has been increased. Now, if those banks are being fair to you, then they should also by now have emailed you that the amount you are going to pay on your loan has been reduced because cost of borrowing or interest on loan has been reduced. So that is fluctuating. It changes. You don't know how much you pay. You don't know the amount you pay at the end of the month. Depending on what is happening, then the amount you will pay will be deducted from your salary. So these are the two different rates you have. So those that are into adjustable rates, that your own will be reduced. And those that are with the fixed rates, you are going to pay the same amount. Please learn to ask questions. No matter how big the institution is, learn to ask questions. Read the agreement that you are going into when you are going for loan, so that you know exactly what you are entering into. Because during the time that interest on loans increase, my bank, I never paid higher rate. They didn't send me any email. So this means that I'm servicing a fixed rate loan. Thank you.